We are standing at the edge of a financial shift so large most people don't even see it coming. The US is more than $36 trillion in debt, 37 almost, but interest payments alone are surpassing what they spend on defense. And every single year they're borrowing just to stay afloat, not to invest, but simply to pay for the promises of the past. The system isn't just stressed, it's unraveling right now. And yet most people have no idea what to do about it. They keep playing the same game inside a system that is already failing. But there is another option, a way to opt out. Bitcoin isn't just a form of money, it's a peaceful exit from a debt-based system that is devouring itself in real time. And today I want to show you how the mechanics of debt monetization, rising bond yields, and fiscal decay, and all pointing towards one conclusion: the system won't fix itself. Let's break this down, all right? So I'm going to unpack one of the most misunderstood and underreported forces shaping the global economy, and that's debt monetization. You need to learn this. It sounds technical, but at its core, it's simple. Debt monetization happens when a central bank, like the Federal Reserve, creates new currency to buy government debt. It's a form of indirect currency printing, and while it can provide short-term relief, long-term consequences are far more dangerous than most people even realize. And it's very clear that most people don't realize this on Twitter. So let's break down why this practice is a serious problem, especially for the United States. The first issue is inflation. When the central bank creates new currency to absorb government debt, it increases the currency supply. And when you increase the supply of something without increasing the underlying value it represents, you eventually devalue it, all right? We saw this play out in real time during the government lockdowns between 2020 and 2022. The Federal Reserve massively expanded its balance sheet, buying treasuries to stabilize markets and fund stimulus. Inflation in the US spiked to 9.1% in mid-2022, and that's just government figures, all right? This wasn't a coincidence. It was the direct result of too much currency chasing too few goods. Food, rent, healthcare prices have reset higher, and they're not going back down ever. That's the silent damage of monetization. It lingers long after the headlines fade, and I think everyone here knows that. The second problem is currency devaluation. When you expand the currency supply too much and too aggressively, it weakens the currency over time. A weaker dollar means Americans lose purchasing power. Imports become more expensive, which hits lower income households hardest. It's effectively a regressive tax, a slow bleed on savings, salaries, and retirement accounts. Next, we need to talk about market distortion. Debt monetization surpasses interest rates, which might sound good at first, especially for borrowers, but what it actually does is encourage excessive risk taking. When rates are artificially low, companies and consumers borrow more than they should. That fuels bubbles in stocks, real estate, and even risk assets like crypto. But it also punishes savers. If you've been holding cash in a savings account, which most of the middle class have, while inflation is running above the interest rate you're earning, you're losing currency in real terms every single day they print more and more currency. Another issue is fiscal discipline, or more accurately, the loss of it. When governments know the central bank will step in and absorb their debt, there's little incentive to rein in spending. Why make tough fiscal choices when you can effectively print your way out of the problem? In the US right now, they're borrowing money to pay interest on money they already owe. This principle isn't going down, it's growing exponentially. This creates a cycle that becomes harder to escape with each passing year. It's essentially finished, in my opinion. And finally, there's the long-term threat: instability. If the US continues down its path, which it will 100%, it risks eroding global trust in the dollar. That trust is what gives the US its unique privilege. It allows them to borrow in their own currency at relatively low interest rates with global demand for their bonds. But that demand is not infinite. If confidence fades, borrowing costs rise. And if global investors begin dumping treasuries in favor of gold, which China and Japan are, commodities, or even Bitcoin, the system gets tested in ways we haven't seen before. These risks aren't theoretical. They've played out dramatically in countries like Weimar Germany and Zimbabwe. Yes, the US has deeper markets and reserve currency status, but even privilege has its limits, okay? So debt monetization might seem like a convenient fix, but it's not a solution. It's a delay tactic, and the longer it's used, the greater the damage when reckoning comes. Before we go further, there's one critical signal we need to cover: bond yields. You've heard it all over the news. Bond yields are the market's clear signal of how confident investors are in a government's fiscal health. And right now, those yields are rising, and they're not just rising, they're rising like crazy. The US 10-year Treasury yields are hovering around 4.7%, more than double the levels seen just a few years ago. The 30-year recently pushed past 5%. That might seem abstract, but it's telling us something very real. Rising yields mean investors are demanding higher returns to lend money to the United States. That's because they're factoring in inflation, credit risk, and long-term concerns about debt sustainability. And this is happening alongside a decline in foreign demand. As I said before, China and Japan, two of the largest holders of US debt, have been quietly reducing their treasury holdings and buying gold. China's holdings, for example, are now under $775 billion, down from over $1.1 trillion just a decade ago. That is huge. So what happens when yields rise and foreign buyers retreat? Well, the fun begins, guys. The cost of borrowing goes up, which means the US has to spend even more just to service its existing debt. And here's the kicker: if the market becomes unwilling or unable to absorb all of that new issuance, the Federal Reserve may be forced to step in and buy its own debt. Guys, that's the end of an empire, in my opinion. That's the moment where debt monetization shifts from a policy choice to a necessity. When the Federal Reserve starts buying again, not because it wants to stimulate the economy, but because no one else will step in. That's how credibility erodes, quietly, mechanically, and then suddenly. That's why watching yields matter, because they're not just about interest rates. They're about trust. They're about confidence in the system. And right now, that confidence is really starting to crack. So if all this sounds unsustainable, it's because it is, all right? But beyond the surface level risks like inflation or currency devaluation, debt monetization also reveals something a bit deeper, something about where the system really stands. Let's take a closer look at what it actually signals behind the scenes. Because when a government starts leaning on its central bank to buy its debt, that is not a policy choice. It's a symptom. It's a sign that the traditional tools of public finance are starting to fail. And guys, this is terminal cancer. This isn't just a flu or whatever. The first and clear signal is this: the US government can no longer finance itself in a sustainable or stable way. Now, if they were running balanced budgets or even manageable deficits, there would be no need for monetizing anything, but they're not. In 2025, the US is running annual deficits between $1 and $2 freaking trillion, and that's during peaceful times in a non-recessionary environment. These aren't emergency deficits. These are baked in the system now. And here is the uncomfortable truth: these deficits aren't funding growth. They're not building new infrastructure or investing in long-term productivity. They're mostly going towards entitlements like Social Security and Medicare. They're going towards interest on the existing debt, which is going to keep going exponential, and defense spending, which will also go up exponential as the currency devalues. In other words, they're borrowing to keep the lights on. Monetization also signals that the economy is no longer growing fast enough to keep up with the debt. We've been saying this for years, all right? In a healthy economy, your economy expands, tax revenues increase, and the debt to GDP ratio stays stable. But right now, debt is growing faster than GDP. They're over 120% debt to GDP already, and every new borrowing round only makes that gap wider. This tells us that growth alone is no longer a viable way out. The debt has compounded too quickly, and the moment rates rise, the interest payments balloon, and that's not a growth story, that's a debt trap, guys. And let's be honest, guys, this also signals desperation. When bond yields rise and real investors begin to back away, the government starts running out of options. They can't raise taxes significantly without political backlash. It won't cut spending because no one wants to touch the sacred cows, Social Security, Medicare, or defense. So what's left? You borrow from yourself. You have the central bank buy the debt and quietly absorb it onto the balance sheet. This is the textbook play when a country is out of road, all right? This is the end game. And it's exactly what the US is signaling right now, not through official announcements, through rising deficits, growing Fed balance sheet pressures, and a Treasury market that's increasingly fragile. And if this continues unchecked, the next signal won't be a bond auction failure, it will be a currency crisis. Because when foreign holders start dumping treasuries, or when confidence of the US dollar starts to erode globally, the problem multiplies. Okay, suddenly it's not just a domestic finance issue, it becomes a global trust issue. And I just did a tweet today at Sir Crypto Tips if you want to know about trust issues in the United States government. And that's when things can spiral very quickly out of control. So rising bond yields, persistent monetization, and unsustainable deficits aren't isolated data points, they're part of the same signal. That's the old financial model no longer working for you, all right? Now they're patching cracks in the foundation with duct tape right now. And smart money is quietly looking for the exits. All right, let's be clear, debt monetization might look like a solution, but it isn't. It's a delayed tactic, all right? Yes, this can stabilize markets in the short term. We saw that during 2008 financial crisis, and again in 2020, the Fed prints trillions to buy government debt and restore confidence, but those interventions didn't fix the system. They postponed the reckoning and made the underlying problem way worse, all right? When the government creates more new money to fund deficits, it doesn't generate real value. It's all fake. And I've been saying this forever now. It creates inflation pressures, it weakens the currency, and signals to the world that we've chosen easy money over hard choices, the American way. What makes this even more dangerous is the illusion of control. It lets policymakers avoid fiscal reform while fueling long-term instability, especially if rising bond yields make traditional borrowing way too expensive. So no, this is not a solution. It's what governments do when they get frickin' desperate, and when every other option, tax hikes, spending cuts, real economic growth, feels too painful or politically impossible, okay? The real fix, it starts with restoring fiscal discipline, incentivizing organic growth, and exploring serious reforms. But even then, trust will take way longer than they have to rebuild, all right? That's when some investors and governments are now looking beyond the old system altogether. Ideas like Bitcoin-backed bonds, sovereign crypto reserves, or alternative settlement layers aren't fringe anymore. They're gaining traction because they don't rely on central banks or trust in fiat. Bitcoin doesn't offer yield, but it does offer credibility, and that's something that no central bank can print. This time it's different. The fuel isn't just optimism, it's concern, it's caution, and showing up in the charts. We're also seeing this shift play out in an institutional level. There's growing interest in Bitcoin backed bonds, sovereign reserves, and even discussions in DC about how crypto fits into the long-term monetary policy or strategy that they have. But then again, that's not going to work either, all right? It's finished in my opinion. This isn't just a fringe asset anymore. It's part of the conversation. And yes, Bitcoin will still carry risks. It's volatile. It's not legal tender in most places, but in an environment where fiat currencies are being quietly diluted and fiscal responsibility is fading fast, Bitcoin looks awfully appealing to those who previously wrote it off, like Saylor, Musk, Trump, all those other guys. Yes, they all wrote it off before and now they like it. But Bitcoin isn't going to go fix any fiscal policy. But it doesn't need to. That's what it offers. It's a way out. It's a way to opt out, a store value outside the system that's slowly unraveling. So if you are feeling like this crypto cycle has a different tone, you are right. This isn't just about getting rich. It's about getting out of a system that's off the railroad, right? It's lost control. And if that resonates with you, if you're trying to understand how all of this connects, monetary policy, crypto markets, debt, inflation, I want to invite you to go a little bit deeper, all right? Come on over to learningcrypto.com. That's where we break down all of this in plain language. We walk through how Bitcoin works, how to actually protect your assets, and how to build a long-term plan that doesn't depend on central banks getting it right, okay? It's education for people who don't want to be blindsided by the next crisis. And trust me, we're not going to get blindsided. So if you're serious about understanding this space, not just chasing prices, but building real financial resilience, head on over to learningcrypto.com because knowledge is leverage. And in this environment, staying informed is one of the most powerful things that you can do. Thank you for watching. Stay sharp, stay sovereign, and stay disobedient. And I'll see you next time. Bye-bye.